Our class in Financial Management 2025 paper. Today we'll look at an important topic, which is risk and return. Question number 3, risk and return. So for us to ably answer this question, perhaps we draw a little back to understanding these two important terms, risk and return. These two are the most fundamental concepts that can be used both in finance and investment. Each investor actually has to face a trade-off between risk, which is uncertainty of their returns, and the expected return, which is a reward of bearing risk. So understanding the relationships between these two for decision making is important. So by the time we're done with this session, we must be able to understand how to measure the expected return of an asset, what risks one can face for holding one or more assets, and how risk can be reduced via diversification, and what is the fair compensation or return for bearing certain risks. So, a return by definition, we can define it as what? The gain or loss that on an investment within a certain specific period. So, a return is simply a gain or loss that is obtained within a certain period of time. So, this can be calculated using what we call the holding period return, HPR, which is given by P1 minus P0 plus D over P0, where D is the expected dividend or income during the period. For instance, we have an investor who buys a share at 100 kwacha and receives 5 kwacha in dividends and sells it for 120. So to calculate the HPR, the returns that can be expressed in terms of arithmetic percentages or averages could be given as follows. We talked about another important term, which is called risk. What is risk? Risk is simply what? The degree of uncertainty about an investment. So in finance or investment, risk is usually measured by variability in terms of CV and beta. So if you have high risk, that's high uncertainty. If you have low risk, you have more stable returns. So there are many risks that investors may face. There's what we call systematic risk. This is the risk that affects all securities and caused by inflation, interest, recessions, and this one cannot be diversified. So we also call this as market risk. We also have what we call unsystematic risk, which is firm-specific risk, and this is a risk that is unique to a company or industry, like strikes or lawsuits. These ones can be mitigated. We also have to understand how to measure this risk and return. So the formula for measuring risk and return is given by the following. So to measure risk and return, the expected return is simply the sum of our expected probabilities in that state and the return in that state. So by multiplying those two, we calculate our um, expected return. We can also calculate the standard deviation and the variance by using the formula below. So I'll start with a simple illustration where we have an asset, okay, whose probabilities are given as follows. So we have probability of 0.3, probability of 0.2, probability of 0.5. So this is an asset which has the following probabilities, and the return for this asset would be given as follows. There's 100 kwacha, here we have a 200 kwacha, and we have a negative 50 kwacha, 40 kwacha. So we are asked to calculate the expected return. So expected return for this asset, asset A, is simply multiplying the probability times the return at that particular point. So 0.3 times 100 is 30. 0.2 times 200 is 40. 0.5 times negative 40 is negative 20. So when we calculate this, we're going to get our expected return for asset A as what? As 50. So is that clear on how to calculate the expected return? This is simply multiplying the probabilities by the expected returns. We could as well put it in a different fashion. It's the same thing. Expected return for asset A is simply 0.3 times the 100 by 0.2 by 200 as 0.5 by the negative 40. Okay. We ultimately will get our final answer as has been calculated, which is 50 as expected return. You can also calculate our variance and standard deviation. So we said to calculate the risk, you can calculate the CV, which is simply our standard deviation over expected return. So the higher the CV, the more the risk or variability involved, hence 100. Or you can leave at 100 if you want. Right, so for the same particular asset that we're looking at in question, the probability is what? 0.3, 0.2, and 0.5. And the returns for asset A are given by 100, 200, negative 40, and the expected return we calculated by multiplying these two. So probability by the return on A, here we had 30, 40, negative 20. And our expected return we calculated as what? As 50. Now we can calculate our variance and standard deviation as follows. So we subtract 100 minus expected return, then we square it. Okay, so here, what is 100 minus 50? We get what? What do we get? Please respond. I hope you have your calculator so I'll move fast. So 100 minus 50 is 50. Then we square the 50, which is going to be 0.500. Then we multiply this times our probability of 0.3. Okay, so what do we get? 0.500 times what? 0.3. We get 750. Okay, we do the same for the second one. 200 minus 50 is what? 150. 150, we square it. We get 22,500. And 22,500, we multiply it times what? Times 0.2. We get what? 45,000. 4,500. Then here, negative 40 minus 50 is negative 90. Negative 90, we square it. Any negative, when we square it, becomes a positive. So here we're going to have what? 8,100. And when we multiply this by the probability of 0.5, we're going to get 40, 50. Are we following? and we add everything, 4,500 plus 750. We get this variance as 9,300. Standard deviation is the square root of this answer. So square root of answer, square root of 9,300. What do we get? 96,044. 96.44. So to find our coefficient of variation, the standard deviation over our expected value, so 96.44 divided by 50. What do we get? We get our 1.92. So if we did this for asset B and we got 1.5, we choose the CV depending on the type of investor. The lower the CV, the lower the risk attached. So depending on the type of investor, the investors who are risk averse, they are investors who are risk takers. Okay, so with that being said, we could be able to now answer our exam question here, where we are asked to calculate.
Sorry,
Yes, please.
before you proceed, just go back to the previous, the one we were solving. A slide, the page.
Okay. I grabbed already.
Oh, okay. So there, on the P times R, there's a part where we do subtract the risk minus the 50. Was that a negative 10 or negative
To the negative.
or negative 9?
Yeah.
Yeah, I remember it was a negative.
Mhm.
Okay, I'll go through it.
Okay. So now, having explained that, we can look at our example here. So we have assets here, A, B, and C. So we're not given the probability, but we assume they have equal probability. So we divide 100 divided by 3, which is the 3.3. So here our probability for asset A is what? 1 over 3. So 1 over 3, 1 over 3. Total should add up to 1. Okay, so the return for asset A, here we have 20, 15, and 10. So we now go to probability times the return on A. What do we get when we multiply there? We calculate. What do we get? So 1/3. 1/3 of 20, 1/3 of 15, 1/3 of 10. Okay. So total we get 15%. We total up here. So this is that 6.33, this and that, 5, this and that, 3.33 somewhere there. So when you add this, you get 10 plus 5 is just 15. Altogether, you define the return minus expected return. So this is our expected return. So 20 minus 15 is what? 5. So we do 20 minus 15, you get a 5. What do we do to the 5? We square it. This is our R minus expected return squared. Okay.
Where the probability is coming from, the ones in the
We're
first
not
column.
given. So if we're not given, there are 3. So if we divide 100 by 3, which is 0.33. Okay, if there are 4, it would have been 0.25, or 1 over 4, 1 over 4, 1 over 4. If there were two, would have done 50%.
Oh, okay.
Okay. Then here we square the 5, which is what? 25. Then we'll square the 5, multiply by the probability. Probability R minus expected return squared. So here, what do we get? We get 8.33. We do the same. Here, what do we get? 15 minus 15 is 0. 0 squared is 0. 0 times 1 is 0. And 10 minus 15 is negative 5. Negative 5 squared is 25. 25 times this one, we get 8.33. Okay. So then we get 61.7. That is our variance. Our standard deviation with the square root of that. Are you together? Is that clear? Huh?
Yes, it's clear.
Okay, so I'll need you to now find as your homework to do the expected return for each of those assets and the standard deviation for each of those assets, and you give me which one of them is what is the best, which one will be selected for each of them. All right. So based on what I have taught, it's enough for you to calculate that. Is that clear? So your homework will be question number 3. I need to calculate the expected return for each, and also I've modified it. Okay, you need to find the standard deviation and also measure which has less risk, which one will the investor choose. Is that clear?
Yes.
Okay. Thank you so much for your time.